And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning. Welcome to the show. Of course, it's 6 early in the morning on this hump day edition of the Real Investment Show. Danny Ratliff joining me today, of course, as always. And a lot of stuff to get into. One of the things that we want to talk about in particular today, though, is why for a lot of people that, performance has really been dragging this year. But there's some interesting kind of issues that surround that. And it's also kind of part of the market. But one of the things I want to talk to you about this morning in particular is that, as we start to, talk about, the kind of where the market's going to head to in the rest of the year. And as, the election's obviously the big issue right now coming up in November. The DNC convention still going on right now. So you're getting a lot of headline news coming out of the DNC talking about economic policies. We touched on some of those yesterday. We're going to start hearing more from the Trump campaign. Obviously, once we get past this DNC, he held a rally yesterday, but you didn't hear much about it because all the media is focused right now on the DNC, and that's fine. But we'll start getting more kind of economic policies, et cetera, over the next month or so, particularly as we get closer to the election. And remember, it's policy that you vote for. We may like or dislike a particular candidate, but we should be voting for policy because that's what ultimately drives economic outcomes. And, and this is one thing that's always kind of interesting to me is that, we look back just since 2008, right? We've had a big surge in healthcare costs, and we complain about, healthcare is expensive, insurance is high. This all has to do with policy that was passed through Congress that caused those increases in healthcare. And a lot of the wage gap disparity, a lot of the wealth disparity is direct results of policy that was passed. So we have to go back and look at those policies and go, was that a good policy to vote for? And if it wasn't, then don't vote for it again. And if it was a good policy, then that's something you vote for, right? So it's just important to remember that policy does matter ultimately down the road, but it's policy that gets passed that is important, right? Promise policies, again, right now you're hearing a lot of rhetoric from both sides, right? I'm going to do this when I get into office. A vast majority of that will never pass because it's just simply getting it through Congress, et cetera, is going to be a challenge. It also depends on who controls House and Senate. So one of the big aspects of the election is not just the election of the president, but who controls House and Senate. So if you have a Democratic or Republican president and you have a split House and Senate, that's going to limit their ability to get things passed. If you have a Democratic president, democratically controlled House and Senate, they're going to get policies passed. Conversely, if you have a Republican president, Republican House and Senate, they're going to get policies passed. If you have a Democratic president or a Republican president, and you have a Democratic controlled House and Senate, or vice versa, you get nothing passed. So, that it all matters on how the election turns out. And that's what the markets will focus on once we start getting into November in particular. And once we get past the election, the markets will really start to focus on that. But one of the issues, and I'm going to share some charts with you this morning from my Twitter feed that I put up early this morning, because this has a lot to do with, I'm trying to do something here real quick. This will have a lot to do with kind of how we turn out for the rest of the year. Now, look, there's a lot of negative sentiment around the markets, around the economy currently, et cetera. And that's certainly understandable, because there's a lot of negative headlines. There's a lot of negative views about things that are happening, kind of around the world right now. In particular, look at the economic data. It's like, the employment data or this or that or the other thing. And that certainly seems worse right now, and yet the markets are doing better, right? And so there's this kind of this fight between how we are currently thinking and what's actually going on in the market. So let's do. I want to go through some charts on Twitter this morning in our Before the Bell segment, and so let's do this. So here's what you need to know before the bell this morning. The markets just recently triggered what's called a Zweig breadth thrust. And this is where you start to see more stocks participating in the markets all at one time. And we've seen a very, very sharp increase in that thrust of shares over the course of the last really 2 weeks in particular, ever since we had this big sell-off in the markets and then we had this big recovery. We've had a very strong thrust and breadth. So a wider breadth in the market is healthy, because you have more stocks participating. And if you go back and look at history right now, in particular, and see how these things have played out in the past, what you normally find out is over the next 6 to 12 months following these breadth thrust, the markets return on average about 23% going back to 1945. Now, that doesn't mean they just go straight up, right? But you're still going to have corrective processes along the way. But these breadth thrust, typically, say that enough times, it's tongue twister, but these thrusts tend to show more bullish action rather than bearish action, because you just have more participation in the markets. It's increasing overall momentum in the market as well. And so that tends to lead to better outcomes. Secondly, we have the highest number of stocks. And again, this goes back to breadth. Right now, we have the highest number of stocks participating in the markets right now that we've had in about 2 years. And this was a chart from Yahoo Finance. Now, there's two things to take away from this. First of all, when you have a lot of breadth in the markets tend to do okay, but it's also kind of the peak of the breadth as well. So we will typically start to see some deteriorating breadth in about 3 or 4, 5, 6 months, right? So, but in the near term, this bodes well for the markets to continue kind of their bullish trajectory that we started at the beginning of this year. It's been a very bullish year so far. The market's up 16%. Doesn't mean the markets can't correct between now and December, but the odds are that we're likely going to continue this bullish trend of the markets that started at the beginning of the year. We will finish on the bullish upside of this over the next few months. So again, just as we've been saying, just be careful getting too bearish too early. Now, one thing that is interesting, of course, as we've talked about this, is buybacks, of course, are driving a lot of this advance. There was a great chart out this morning talking about share buybacks, which if you take a look at global buybacks, that's the yellow line. The blue line are dividends. you can see now that buybacks are accelerating much faster than dividend payouts from companies. This is now the new kind of goal for companies, is to buy back shares. And currently, out of the top 10 global companies, this is not just the U.S., this is globally, this is everywhere in the world, this is every major company everywhere in the world, 9 of the 10 of the biggest share buyback companies are U.S. dominated, right? So that's Apple, Microsoft, Google, et cetera. And they make up alone 25% of the entire buyback process. So that's where all that lift in the market is coming from, is primarily coming from buybacks, which, as we've talked about before, has been driving bull markets really since 2010 more than anything else. But again, that form of liquidity is continuing to support markets as, at least for now. That's what you need to know before the bell this morning. We'll come back, pick up with Danny Ratliff, talk about a couple of interesting risk in the markets, but also performance issues in the markets as well. So don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So welcome back to the show this morning. Danny Ratliff joining me. Good morning, Dan. How are you?
Lance. Great. You?
Good. Well, doing well. It's a Wednesday. Talking a little bit about markets and again, we're in clearly a very bullish markets right now. And I know there's a lot of economic data that we worry about, that we talk about, lots of super negative headlines out there about crashes that are coming and this and that and the other thing. I get all that, right? So it's important to understand that. But it was interesting. Like I was posting some stuff on Twitter this morning, and I got a comment back, and it was like, but all this negative stuff that's going on, why is the market being so bullish? And it's like, well, it's not really that negative, right? Employment's still positive. It's not 300,000 jobs a month, but we're still clipping off 100,000 job growth a month. So it's not negative. Right? Services are in expansion territory. It's not negative, and that's 80% of the economy. Manufacturing is in contraction. That is a negative, but again, we're 80% services. So it's not surprising that the markets are doing well because of that, because earnings growth is still growing, right? So that's, and markets are going to follow earnings growth over time. But then lay on top of this, you have just a lot of exuberance in the markets, right? And exuberance drives markets. People are trying to buy stuff. And there was a really good chart out this morning. Brent, if you can bring this up for me. There was some analysis out this morning. This is, kind of the category launches as a percent of total of ETFs over time. This year, 50% of all the ETF launches this year are derivative based. Now, what does that mean? That's basically ETFs that use options. So we've done a tremendous number of new launches this year of 2x levered single stock ETFs. So this is which doesn't make any sense to me. Why I would pay a fee to buy a stock that I could buy for free in my portfolio. But these are basically why I pay a fee to buy an option that I could buy in my portfolio for free. But people are buying these ETFs that are simply Apple or Nvidia, whatever it is, and it's just leveraged 2-for-1 with options. So you get double the return. So if Nvidia goes up 1%, the ETF goes up 2%. Now, the important thing about this is that these derivative option-based ETFs are very speculative. And this is a function, of course, as we've talked about before, is that what is Wall Street's job, right? Everybody seems to think that Wall Street's out there to protect you and help your investments grow over time. And one of my favorite commercials is for UBS, Union Bank of Switzerland. It's UBS, you and us. We're in this together. No, they're not in this with you. Their whole job is to sell you product. And right now, there's a huge, and this is part of what I'm saying is that there's a huge demand for taking on risk in markets. And so what's Wall Street doing? They're selling you these products. Now, that's a very bullish backdrop for the markets. We saw this in 2020, 2021. Remember, we were doing IPOs and SPACs and all these other derivative instruments to get people into the markets, right? Because there was a lot of demand for these products. Well, we're seeing that again today. So that's bullish in the near term. That's a lot of momentum. That continues to drive markets. Now, that will eventually fail. Remember so 2020, 2021, ripping markets. Everybody's happy. 2022, everybody's not so happy. And a lot of those products went completely bust. That will happen again. But for now, the point is that momentum is driving the markets, which brings us to our topic today with Danny, is why your portfolio performance probably sucks. Which is, for a lot of people, they're looking at their performance of the markets. Markets up 16% this year. Quite a phenomenal return, but their portfolio performance isn't doing nearly as well. So, Danny, before I've actually dug up a chart for you this morning right on this very topic, but right. We'll get to that in a second. Throw me some comments.
Well, there's a new Morningstar report that came out that shows that for the last decade, ending December 2023, that there was actually a 15% gap in actual market returns and investor returns. And this is indicative. You and I talk about this frequently, is that, we have a habit of wanting to try to time the market, and historically we don't do such a great job. And a lot of that is obviously we sell when things have gotten a little bit lower. We don't wait for that bounce, or we don't wait or have that long-term approach. Now, there's a couple things that I found interesting in this article. Now, obviously, or the report was essentially some types of investments and or funds, actually the gap was a little bit wider or not as big. So the difference between ETFs and mutual funds, there's a pretty big difference. Mutual fund investors, believe it or not, which we don't even use funds very often because we don't want to overlay an additional expense for our clients. But individual investors who are using funds, their performance historically is a little bit better than an ETF investor. And I think it's probably the accessibility. We can buy an ETF this morning, we could sell it this afternoon. Whereas if you buy a fund, you're going to buy it at whatever it trades at the end of the day. So 4 p.m. Eastern, 3 p.m. Central. And then you can't buy and sell, so you can't trade it like a stock.
Right.
And I think that's probably one of the bigger things. ETFs have made things so much easier for people to get in and out. Also, you think about what's happened over the last 10 years. And you and I have talked about this. The average holding time of investors for a position used to be, many years.
6 years.
It was like 6 or 7.
Yep.
And now you don't even get a full year for many people. Some people don't even wait for that long-term capital gain.
You're down to 4 months.
Yeah.
4 months. is the average holding period now.
Well, and I blame, and I think we all can, how easy it is to trade, right? You get on your phone, oh shoot, okay, we're going to get out of this. The news comes at us, so rapidly, and many times say, oh man, this looks terrible. I'm getting out right now, and I think that is part of our problem when we see these returns in this bigger gap.
No, it is. Look, the worst thing we ever did to the financial markets for investors, right? The worst thing that we ever did to financial, investors, just the average mom and pop retail investor, et cetera, was to decimalize the system, get rid of trading commissions, and allow online access to trading, right? When you used to have to call, and it's unfortunate, right? Because, back in the day when the average holding period was 6 years, you had to call your stockbroker, place an order. This was where I was growing up. You had to take the order, you had to write it down. So time's ticking, right? I got to write the order on a piece of paper, roll it up, put it in a vacuum tube, go over, put it in the vacuum tube thing, and suck it up, send it over to the trading desk, who would then take it by compliance, make sure it's all good. Then it would get to the actual, it would take an hour to get a trade done, right? But it would slow things down so that people had time to think about stuff. You had to wait for the Wall Street Journal to get the news, right? Yep. And so by the time you got it from the Wall Street Journal, it was already 2 days old in most cases. And so we didn't freak out over a 1 cent earnings miss or, and make all these emotionally based decisions that go on today that really erode market returns. But that's just kind of part of this outcome that we've done to investors. And unfortunately, it's made things a lot worse in terms of portfolio performance, returns over time, wealth building. It's just destroyed a lot of that.
Well, I think a lot of people are somewhere in between a day trader and probably a long-term investor, and that's the problem with many.
They say they're a long-term investor. They're more of a day trader.
They're somewhere in the middle, I think, generally speaking, and I think that's where other issues come into play. I can remember when we first started, I had a lot of clients that were charting everything. They're waiting for the paper to come out. Yep. They're looking at it. Okay, hey, they're charting all the fundamentals. They're charting stock prices. They're looking at all the data over long periods of time. And, one thing I can recall was that many people would, when they talked about their accounts, they'd say, well, I'm a portfolio manager. But they were long-term and they were building things out. Now, the difference is a lot of the other difference, I think, is that, back then fundamentals really mattered, where now, people are trading on, they're trading on quick news, they're trading on momentum. And really, we can argue fundamentals have been thrown out the window for some time. Now, I think we can all agree at some point they will matter again, but we've just been through an extended period of time where it really hasn't. And so that's made it difficult for many. But I think the biggest thing I found from this article, Lance, was essentially the ETF and versus mutual fund holdings. And then if you look at just going into kind of the individual positions, like certain asset classes actually did better than others. So, looking at versus alternatives and normal asset classes, there's a difference there. And so you kind of alluded or discussed that a bit ago with, like derivatives. So now we have an ETF that can do many, many different things. And so as people are starting to explore and invest more in these types of areas based on a thesis or a theme that they believe, it can be really good, but it could also be really bad on the backside of it. And so something like that, you do need to trade a little more frequently. So this sophistication of markets isn't always great for individual investors.
Right, and we just got a comment in our chat which goes right to the heart of this. It's interesting. It's like, why pay a fund manager? We can just buy an S&P 500 ETF.
Yeah,
that's a very true statement. However, it's also a false narrative. Because, and again, this goes back to what we're talking about mutual funds versus ETFs. Mm-hmm. Most mutual funds are actively managed. Now, yes, I can buy a passive index mutual fund, right? Those existed before we had ETFs. So I could buy an S&P fund that just tracks an S&P 500 index. So those do exist. But most mutual funds that existed, prior 2008 were actively managed. And some of these guys, right? Peter Lynch, Sequoia funds, these type of guys. American funds. And this is part of the problem we discussed yesterday, is like with the SPIVA report that comes out and says, 80% of fund managers underperformed their index this year. Maybe they did this year. But in a lot of cases, the fee you pay for a well-run portfolio manager or a well-run mutual fund will outperform an index over time. Peter Lynch, as an example, Fidelity Magellan Fund. Fidelity Contra Fund is another great example of this. These funds, Sequoia Fund, et cetera. I've done studies on this. If you go to realinvestmentadvice.com and look up articles on passive investing, I have articles on this. But they absolutely have crushed, not by a smidge, they have crushed the S&P 500 over the last 30 years, 40 years. You're much better off paying the fee for that. We'll come back and talk some more about this, but we'll talk specifically about why you're likely underperforming the index this year as well. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint. Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
Davey's always saying, I can't retire.
You can't.
Visual Capitalist put out a graph this morning. The title of the graph is, How Much Longer Do You Have to Live? It's a very sobering graph for 6 o'clock in the morning.
The Real Investment Show podcast.
You look at this graph and then you find your age. It says, I'm going to die roughly about 78. So I've got about 18 years left on my ticker. So I'm retiring soon.
At realinvestmentadvice.com.
The sand in my hourglass is running out.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, plus each day's radio shows. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. So just talking a little bit about market returns and why, the average retail investor vastly underperforms markets over time, even indexing. And there's a whole variety of reasons for this. Again, primarily, most of the underperformance comes from bad emotional mistakes, right? You're reading headlines, like Danny was talking about, it's like something's going on. You read headlines, you immediately take a knee-jerk reaction. Good example, 2 weeks ago, right? Retail investors were dumping stocks like crazy on Monday when the yen blew up, and we saw it across the board. So but that was a one-day event that immediately turned around, and now we have retail investors piling back into the markets to get back in after they just sold. But that leads to that underperformance over time by making those kind of emotionally based decisions. And that's why, one of the things that we try to do here is try to temper that emotion a bit. So this is why we talk to you about, hey, just here's these headlines, here's the doom and gloomers over here, here's the super bullish stuff. Let's talk about the other sides of these arguments and try to temper some of that emotional bias so that you can stay invested over time. This is why we talk about doing risk management, taking some profits, rebalancing risks, selling laggards, just small move. We talk, consistently small moves, right? We make small moves in portfolios, don't make big knee-jerk reactions. But one of the big reasons that you're likely underperforming the markets, and one of the reasons that most managers are underperforming the markets, and in terms of, we're talking about specifically the S&P 500 index right now, but it depends on whatever benchmark it is. So if you're 60-40, 70-30, 80-20, whatever your allocation is, you should have a relative benchmark for that based on your risk tolerance. So if you're a conservative investor, your benchmark should not be the S&P 500. It should be something relative to your allocation. But just for sake of conversation, I have a chart here, Brent. The reason that, and again, we're talking specifically about the S&P 500 right now. Okay, so specifically that. The reason that most large cap mutual fund managers are underperforming the index is that they're weighting of the Magnificent Seven stocks in particular, or really we just call it Mag 7's kind of the moniker now, but let's just call it the top 10 stocks. Their weighting in those top 10 stocks are far different than the weighting in the index. Those top 7 stocks right now make up 32% of the index. The top 10 stocks make up 37% of the index. So if I'm going to match the index, 37% of my portfolio has to be in those 10 stocks. If I don't have that weighting, I can't track the index. It's physically impossible. It'd be like saying I'm going to go to the racetrack. I'm going to go to a NASCAR racetrack with my Volkswagen, or I'm going to go to the NASCAR track with Brent's Mazda Miata. Hey. Got little rubber bands in it and gerbils in the back. But it's just there's just no way to perform, right? The engines are different, right? And so I'm not going to be able to keep pace with a NASCAR vehicle. And that's the way the markets are built right now. The markets are built for momentum. When you have the top 10 stocks making up 37% of the index, it's all about price momentum. And as long as people are piling into ETFs, 37 cents of every dollar that goes into an ETF fuel those stocks. And, despite the fact there's headlines like, AI sucks and this is terrible and this is bad and this is bad, these stocks are going to continue to go up because there's so much money flow going into those stocks that are driving those prices higher. And you can't stop. It's like that commercial. You can't stop a train, right? That's kind of what's going on with the markets. It's just pure momentum right now. But that's the big reason. So if you look at your portfolio and go, I don't understand why the market's up 16 and I'm only up 8 this year. It's your weightings. And I don't recommend, Danny or I, neither one would recommend that you try to weight your portfolio relative to the index, because eventually when we have a big correction, like 2 weeks ago, those stocks got absolutely pounded. And now you're at home completely freaking out because now your portfolio is down extremely sharply for one day. And now you're back to making emotionally bad decisions. You're panic selling at bottoms. You're doing things that are going to ruin your long-term returns. So this is why we talk about managing risk.
Yeah, and I think it's important, that chart. And so if you look at that index versus the mutual funds, is it prudent? And we see a lot of people that will actually overweight, and while they've done extremely well, right? You've got to know when is it time to exit. And I think that's where most struggle, is that once we do get in, if you've seen something that goes up, and it's human nature, with you've done very well, you say, hey, we're going to let this continue to run, and we get a little bit greedy over time. But what many forget is that nobody wanted to touch those stocks with a 10-foot pole in 2022. If you look at NVIDIA was down substantially. Now, granted, it has been, it's been on a historic run. But, if you were to overweight And somebody mentioned ARC in here earlier. Yeah. You have to remember what the mandate is on each fund as well.
Right. And again, specifically, Danny, I said good fund managers. Okay, so
she's a great fund manager in specific times. But everything's got to be hitting.
I'm talking about a guy like Peter Lynch who survived multiple downturns in markets.
Yeah, but the key here is that we have to remember that they have a mandate, an investment policy that they must stick to. And so they're not going to go to cash. If you're in a tech fund, guess what? Tech could be off by 50%. They're still going to be a tech fund. And they're still going to invest. Now, maybe they raise a little bit of cash, but you have to go back to that investment policy they have and understand, do they have a requirement to keep those funds invested? And 99% of the time, it's going to be yes. And so that's where I think we need to understand exactly how each one of these works. If it's an index, it's an index. It's going to remain exactly identical to whatever the index does, plus or minus whatever that fee is. Mm-hmm. And if it's a fund, we have to understand it's not typically, while it may be actively managed, meaning that they may underweight or overweight specific areas or positions, but if it's tech, and I'm picking on tech, it's going to remain tech. And then, the other thing you mentioned, comparing the index. And it's always interesting because most people want to compare the index like, well, the NASDAQ's doing this or the Dow's up. So it's whatever's up the most during that time frame is usually the index that we kind of gravitate towards. And I get it. I mean, it makes sense. We always want to say, well, here's what the best did. Why are we not right there? Well, do you own cash? Do you have bonds? What other alternatives do you own? Do you have other types of investments? And I think that understanding, what is a good benchmark for you, and then bringing it back to, at the end of the day, what is your goal? I think we look at it too much like a casino where we're looking to build wealth quickly. We get a lot of calls from somebody who may be really close to retirement and say, look, I don't have the funds that I need to sustain my lifestyle. So I've got to get really aggressive over these next 2, 3, 4, 5 years. And that could be great if the wind is at your back, but if it's not and things fall off, man, I mean, the impact that can have on your overall financial plan can be devastating. And so, my kind of retort to that always is like, all right, so you make an extra 10%. Is it life-changing? Probably not. But if you lose an extra 10, if the market's down 10, 20%, 30%, what does that do? Well, now we're likely working longer. We're really changing our lifestyle. There's so many other things that this impacts. And so it goes back to how do all the pieces of the puzzle fit together? And I think that's one thing that, we don't often think about. Where's the goalpost? What are we trying to achieve with these funds? But we're looking at what is the market? That's where I've got to be. And, maybe take a step back and rethink how you're looking at this.
Right. And again, percentages are always very interesting, when we talk about things because, if you look at a long-term, I always like these charts that come out and they show like the long-term returns of the market. It's like, look, during this period, the market was up 5,000%, but only in this period, it was only down 30%. So you have these big mountains on the top side. And you have these little bitty blips on the bottom. It's like, see, downturns aren't any big deal. But that's so deceiving because a 50% gain in the markets is very different than a 50% loss because you're just calculating the gain from kind of where you are. But when you're talking about a loss, you're talking about the entire zero to wherever it is. So these losses are much bigger on the downside in terms of the capital destruction that happens to your portfolio than what it may seem like. And again, make it, great, I'm up 10%. That's awesome. A good example, I start out with $100 and I go up 10%. So I make $10, right? And so now I'm at $110. Now my 10% loss is not just $10. I don't go back to 100, right? Because I'm now talking about 10% loss on $110. So these downside percentages are much larger to your capital destruction than your gains. Even though it seems like it's the same percentage, that's where people kind of go wrong with piling on risk in their portfolio, trying to capture every little bit of return. Yep. They don't understand what the risk of that is.
Well, I've had these conversations in the past where somebody says, well, I can make 50% and, what I'm doing. Okay, great. What happens if you lose 50%?
Right.
Oh, it's okay. I'll make 50% back. I'm back. No. You need to make 100% to get back, right? Exactly. And that's the issue. I talked to a gentleman this week, in fact, who's been a long-term investor and done extremely well for himself, looking to hire an advisor essentially for his wife and his family. Like, hey, I'm getting older. I can't do this forever. And he said, the first time I bought a stock, I want to say he said it was 1966, February of 1966, I believe. He said the Dow was at 1,000. He said, you know what happened then? He said I had to wait till like 1980 to get back to 1,000 for the Dow.
Right.
He said, but as an accumulator, I was consistently putting funds aside, so it was great. Had I been going into retirement,
It'd been terrible.
it'd have been awful.
Yeah.
And we've seen that even more recently if we look at the lost decade from 2000 to 2010. In fact, it goes a little bit longer than that. But that's where we need to begin thinking about, okay, what about destruction of capital? How does that work long term? How does that work for you? And then tying all those things together is something I think is extremely important. And understanding your risk and your parameters, right?
Quick change of topic. We'll come back. Products. And we talked a little bit about products earlier. A lot of products out there right now that are promising big upside, but is it really what you get? Talk about that when we come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Building anything of substance requires careful planning, including your retirement. You need a blueprint to structure your funds against volatility and turbulence in the market. If you fail to plan, you plan to fail. Richard Rosso and Danny Ratliff share the RIA Retirement Blueprint, Saturday, September 14th at the Hyatt Centric in the Woodlands. How to structure your savings, level your risk, and craft a secure future. Register now for the Retirement Blueprint with Ratliff and Rosso at realinvestmentadvice.com. Realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning. At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. I'm your host, Lance Roberts. Of course, Danny Ratliff joining me today. Talking about I wanted to switch gears here a little bit and talk about some products that are running around right now, and they're promising outsized returns, or at least what appear to be, really enticing returns. And it's like, oh, if you just invest in this, you're going to get X over a guaranteed period of time. So over, there's a lot of what we call derivative type products, as we discussed earlier, that promise X amount of upside with what seems to be no downside risk. But these things don't often work out that way because of how markets work over time, and things tend to go wrong. And we see this in structured notes. We see this in annuities. We see this with a whole, CDs that are linked to a specific stock. You've got to really understand. Now, I'm not saying these products are bad at all. I'm not saying that. I'm just saying you have to really understand what you're getting yourself into and understand, why is this product being issued? More importantly than anything else, who really benefits from this over time? And again, like for instance, structured notes. We see these quite often where it'll be, hey, here's a structured note on Goldman Sachs. And it guarantees you that over 3 years, that if the stock goes up, you're going to get X amount of return, but you've got no downside risk, or you've got some limited downside risk. First question to ask yourself is, why would anybody do this? Why wouldn't I just buy the stock? Well, what's happening is there's a hedge fund or a big pension fund or somebody else that needs to offload or to hedge their position. And so this is the way they're doing it. They're creating a product where they can hedge their position. If the stock goes up, they make money. If not, they can basically sell their shares and keep their principal. So it's just a hedge for them, but you're taking on the byproduct of that and accepting some risk and limited returns. So buy the stock, right? So just always ask yourself the question, and we talked about this with private equity previously. Why are you so lucky? When somebody offers you a product, the first question you ask yourself is, well, why am I so lucky? Because again, if there's a good deal out there, trust me, an institution already bought it. It never sees the light of day for retail investors. So always ask yourself the question, why am I so lucky? And it'll save you a lot of pain and heartache over time. But Danny, I mean, you just ran into this just recently with an annuity product.
Yeah. So, this is something I hear quite a bit. So talking about the sophistication of all these products that are out there and the marketing surrounding it. We visit with a lot of different people, and many people have annuities. And I really do think, I think a lot of people think we give annuities a hard time. I think annuities have a very good place in the right portfolio. And we don't use them, very often. But for the right person and the right plan, I think it can be a great tool. But the problem I find, and I continue to run into, and it hasn't been as prevalent as of recent, Lance, but, most people will say, well, okay, tell me, I always want to know, if somebody holds an annuity, tell me about it. What do you know? Tell me how it works. And I would say 90+% of people don't understand the annuity that they're in. But when they do, and I came across an article which kind of sparked this conversation where somebody said, my financial advisor put me in a 10-year double guarantee investment. It's been 10 years. My money hasn't doubled, and he doesn't have an answer. So not only do sometimes I find that the client doesn't understand it, but sometimes the advisor doesn't even understand. And so, and I think this is a lot of it because, they're pushed by, especially if you're working at a big firm, it's the next greatest, best thing they're being pushed. Hey, you guys need to go sell some of this. And that can be problematic as well. But what it boils down to is that understanding exactly how these products work. So many of these annuities will have an income rider. And so in this instance, and in many, people say, well, hey, my money will double in 10 years. Well, so my first question with that is, okay, that's money that you can take out. In 10 years, your contract is up. You put $100,000 in and it's $200 now. Can you step away with that $200,000 and put it in your bank account? If it's an IRA, roll it over to another IRA. Is that possible? And most of the time they say yes. And I can tell you almost every single time that amount, that interest that they're giving you, that they're saying is going to double your account, that's not the money that you can walk away with. That's historically the money that you're going to be able to take income off of. Now, that could be great because usually what they'll say is that, hey, we're going to lock it in every year on your anniversary date. We're going to give you 7%, but if your account value is higher, we're going to lock it in at that account value. So if you made 10 that year, we're going to lock that income rider in on that 10% versus that 7. So you have the ability to grow this. Now, we also need to start thinking about what are the fees associated with something like that, because you're typically paying a mortality and expense ratio. We see that historically over 1%. You may be paying a rider fee. You may be paying a fee for a number of different things. I mean, I have seen some of these where, especially on a variable annuity, they're not nearly as popular as what they once were. But your fees can get up to 3%, 4%, 5%. So you have to overcome that for your account to actually physically grow. And so many times the money that you can physically walk away with is much less than the money that you can take income from. Now that may be okay because we may look at this and say, okay, we know at minimum you're going to be guaranteed to get X amount in income in retirement. So we may want to use that to fill a gap. If you want to wait for Social Security, we may use that for, hey, I know my Social Security is this, I have a pension, it's this, and my other income looks, this is what it is. And okay, well, you want to spend X amount, well, we can guarantee that with something like this. But the problem still boils down to is that most people don't understand what they have. And this was a prime example.
Right.
And so I think there's a lot of frustration surrounding these. And I think that's where they get a bad rap, is that most people don't understand it. The advisor maybe didn't explain it, or it was based on more of a sales pitch versus something that somebody actually needed. And, that's where we're seeing, you look at all these different types of products that are coming out in different times. What happened to SPACs? Where'd those go?
Yep.
What happened to all these other types of investments that are out there that, they're hot for a moment and then they disappear? And a lot of times, the rep disappears with it as well. You see some of these guys that go, then they change industries. I've got a buddy I saw a while back, and, like, hey, you still at the same place? Oh, no, I'm over here now. But always jumping from, what's the next hottest industry to the next, to the next, to the next. And it makes it difficult for clients to keep up with things when you don't have anybody to rely on and who's kind of your voice of reason to say, okay, hey, hold on. Here's how this works. Here's what this looks like. And unfortunately, so many times we have to kind of step in and say, be the bearer of bad news.
Exactly. But this is also one of the big myths of the market as well, which is that the markets average a certain rate of return over time. And so a lot of these products are based on, well, if you get this average rate of return over time, then you're going to have this much money in retirement. The whole rule of 72 is a good example.
Oh, it's a great example.
Yeah, it's just, hey, it's just if you can just average 7% a year. The issue is that, yes, markets average 7% a year. And Brent, if you'll bring this chart up for me. So this chart goes back to 1965, which is basically the beginning of kind of the S&P 500 launched in 1957. So starting from 1965 to present, we get a kind of an average kind of run of returns to where we are today. And I've extended that using historical variability in market returns, bull markets, bear markets over time, going out to 2061. So, you're kind of just saying, okay, if I started investing in 1965, where am I today? And if I get the 7% average rate of return, where will I be in the future when I retire, right? So that's the whole idea. That's what the markets average 7%. That sounds fantastic. Well, the purple shaded area is compounded returns. That's if the market returns 7% every single year, that's your compounded average rate of return over time. The green is what you actually got, and the orange is the deficit between your portfolio and those compounded returns. Markets do not compound because one single year of loss destroys your compounding effect. What does compound? Bonds compound. Because if I buy a bond, I get a set interest payment every single year. My money will compound because of that interest payment over time. Anything that has a set principal value, a CD, markets will compound over time. But you cannot lose principal. Once you have a negative rate of return, you destroy the entire effect of compounding. As we talked about before, there's a huge difference between a 10% gain and a 10% loss in your portfolio. 20% gain, 20% loss, 30% gain, 30% loss, because of the impact of negative returns on value over time. So that's the problem with a lot of these products that say, well, if you just get that, and that's the first big red flag, right? So if you just get the average rate of return over time, you need to step back from that and go, well, what if I don't? What happens? Because that will have the biggest impact to your portfolio over time. This is why we spend so much time talking about risk mitigation, loss avoidance, because look, if I don't have to get 100% of the upside. And this was Peter Lynch, this was Sequoia Management. Go back in history to the great fund managers. They didn't worry about beating the index every single year. Their bigger focus was on not losing large chunks of capital, because over time, if I can just get 80% of the market return on the upside, but only capture 20% of the downside, I will vastly outperform the markets over a long period. I will never beat the market from one year to the next. So if you're looking for that, that's, go buy an index fund, right? And you're still not going to beat the index. You'll just get the index. But over a long period and saving for your retirement, don't worry about beating the market. Worry about avoiding the losses. And again, don't expect to avoid all the losses. Again, 20% of whatever if the market's down 10 and you're down 2, perfect. Because if you're up 8 when the market's up 10, you're going to wind up beating the market long term because you're not spending so much time getting back to even.
Yeah, and markets go up more than they go down. But it's devastating, the destruction that it does to your funds when they go down. And especially the closer you get to retirement, we do need to think about that. So, lots of moving parts associated with that, but understand at the end of the day why you're doing what you're doing. What is the purpose? What is the goal? What's your objective? And I think that puts things in perspective. And then what type of downturn can your portfolio withstand to still meet those goals?
Absolutely. All right, Dane, thanks so much. All right, wraps up the show for today. Be back tomorrow with Michael Leibowitz. We'll be previewing the Jackson Hole Summit speech on Friday. Talk about some of the latest economic updates. More all here tomorrow on The Real Investment Show. Like and subscribe to the channel. Get to the website. Get our latest articles all up now. Michael Leibowitz's article out yesterday. RealInvestmentAdvice.com. See you tomorrow.